Thank you for joining us. You are in for a treat with Denise Reed from Edgewater Research. I can guarantee that today. My name is Bolaji Ojo, publisher and managing editor of the Ojo Ishida Report, and this is the Electronics Lifecycle and Supply Chain Summit. Just some housekeeping stuff. If you have a question for Denise, please tap on the Q&A tab on the upper right corner of your screen and type your question into the window. We will try and answer all of your questions live. Whichever one we can't answer live, we would answer in the Q&A tab or get answers to you later on. The session that we're hosting now is on electronic components industry outlook, trends shaping the industry in 2025 and beyond. Denise Reed is a senior research analyst in technology at Edgewater Research. He has taken on the task of looking beyond 2025. And we know this is an industry where even looking at 90 days can be pretty difficult. So Denise has quite a job on his hand, but I can assure you, having spoken with him extensively recently, he is really, really up to it. In this session, Dennis will address the ever-present question of where the industry is going next, and he will talk about how it makes sense and create actionable insights from the data to draw conclusions for you. Denise, you're welcome, and thank you for joining us.
Thank you again for having me. Let me just get my screen live here. But thank you again, everybody, for having me. A lot to cover today, so I'm going to jump right into it. To start, we're going to do a quick introduction of Edgewater, who we are, what we do. And then secondly, we're going to talk briefly about the NVIDIA/AI halo effect. And really, what I would emphasize with that is when you look at data sets across the industry, there's been such a bifurcation that'll be an undertow of the presentation today, that a lot of these data sets are, in a lot of cases, not syncing with the reality inside of your business. So we're going to address that and throw some numbers around it. We're also going to look at inventory. I'm sure that's top of mind for everybody, and try to aggregately put a flag in the sand of how much inventory we built and what that means for the growth outlook next year before looking at a supply side and a demand side, and wrapping up with our industry sales forecast by the key markets that we follow, being semiconductors, interconnect, and then the passive markets. So to start, who are we? We're an independent research company. We specialize in technology, internet/digital, in the consumer e-commerce space. We service a bulk of the largest money managers in the world who invest in technology companies, and we do this and we provide critical business insights through what we call our fundamental research process. And our reputation dates back over 2 decades. Our team alone in technology brings north of 65 or 70 years of experience. So a long way of saying, each cycle is different, but we've collectively lived through a lot of these cycles. And then why do our customers work with us? We're deeply connected in the industry. So in my role, I literally spend my days, weeks, months engaged with people like yourselves across the supply chain, from sand to silicon to the supplier base, through distribution, EMS, and then ultimately the procurement arms at several of the largest OEMs globally. As I mentioned, we are a trusted resource for the investment community that actually stands to benefit our insights in 2 ways. One, naturally, it keeps the lights on at Edgewater, so we're grateful for that. But 2, it actually gives us a lens into what people are investing in from a technology standpoint that you guys are all collectively working on. And then, as mentioned, we are a critical partner for our industry customer base. We do work with them to identify the key trends in the marketplace and assist them in shaping their strategies to ultimately capitalize on those opportunities. Couple of ways to work with us, won't go into great detail here. And then a little bit about myself. My contact info is there. I think this is also in the library on the Edgewater booth virtually. But in terms of my background, I have over 12 years of experience. I actually started doing this back in 2004. worked with several different companies before leaving the industry for a bit in 2013 and returning in 2020. Since 2020, I've been with Edgewater and have obviously lived through quite a dynamic marketplace. So to start, just want to start at a high level with inventory levels of the supply chain. And I'll be the first to admit this is backwards looking. So this is 2Q data. We just wrapped up the reporting season for 3Q early this week. So the data is due for a refresh. But a couple of things jump out to us. First of all, what I will say is if you look at the days change on both a quarter over quarter and year over year basis, so the days of inventory across the supply chain, commendable work in the supply chain, drawing down days sequentially in virtually all the categories, but also drawing down days on a year-over-year basis. The one anomaly is the OEM space, where we did see sequential growth and year-over-year growth. That doesn't worry us. That is dominated by the compute marketplace. There's some level of seasonality versus peak selling season in the fourth quarter. And then, of course, there was some positioning of inventory ahead of AI launches. So that doesn't worry us in aggregate. But what I will tell you that does worry us and really goes to the overall question, if you look at days and dollars of inventory relative to 2020, on a dollars basis, we're 63% above where we were in 2020. So really the last quarter prior to the shortage, and on a days basis, which can account for pricing, sales growth, et cetera, we're close to a third above where we were. So, in aggregate, when we look at inventory on the supply chain, we went from an environment of just in time to just in case to just too darn much. As we work through this, I think our stance is we'll ultimately work back to that just in time environment, because the pervasive belief in the supply chain is, frankly, it's just much too expensive to hold inventory. So again, here to level set a bit, and I'd be the first to say, unfortunately, the timing of this was a little bit off because our good friends at the WSTS raised the growth numbers for this year. But again, I really want to set the stage of how much inventory is being built. And to do that, if we look at the CAGRs from 2014 to 2019, so really that 5 or so year window prior to the shortage, including memory, we grew at a 4% CAGR. Excluding the memory markets, it was a 3. We saw that doubled X memory, or X memory when you include the shortage. And then if you look just at the shortage period, we've seen the CAGR essentially triple. So rhetorically, when we think about how much inventory and the AI halo effect, I just want to level set with everybody in the audience. Can you name another market of size excluding AI, and in particular excluding the leading processor supplier? Can you name a market of size where the growth rate has tripled during the shortage? And I would unequivocally argue that no growth rates have tripled, and as a result, we're continuing to slug through inventory here in a relatively prolonged downturn. So as we zone in on that AI impact, I just want to show here a basket of companies where we looked at from the compute supply chain. So this includes companies like AMD, Intel, NVIDIA, your memory suppliers, the hard drive suppliers, et cetera. So these are your kind of major compute suppliers. And as you can see by the green line, sales peaked out somewhere in the fourth quarter-ish of 2022, relatively sharp correction that bottomed, essentially 9 months later. And then we were off to the races in the gray shaded areas, Wall Street's view of what sales are expected to do going forward. So by effectively a year later, we have already, in the compute supply chain, we have already achieved, previous peak level sales. But I think, as most would agree, this recovery has not been made all things equal for all suppliers. So if we look at that and then compare that growth to the high performance analog semiconductors. So these are suppliers, right, like Texas Instruments, ST Micro, the guys that make hundreds of thousands of parts that they sell to tens of thousands of customers. No single market really ultimately drives the business. You could see, sales peaked a touch later, which we would ascribe to as a result of non-cancelable, non-returnable programs. not necessarily as sharp, although it was sharp. And then again, if you look at the time that it takes to ultimately go back to those previous peak levels, currently Wall Street's projecting sometime in the second quarter of 2025. We can debate, all we want, and that's not the point of this discussion. We could debate how accurate those are, but I would just compare and contrast the ultimate growth outlook for that compute marketplace, and then ladder that to your broad line semiconductor manufacturers. To identify that point, or to talk on it a little bit more, I've looked at that compute basket, but I've actually stripped out NVIDIA. And as you can see, a couple of things here that jump out to me relative to the first chart of the halo effect. One, if you look at the magnitude and the steepness of the downturn, significantly steeper trough level, and subsequently we're looking at a recovery that is not expected until about the second quarter of 2025. So again, here's some data that I would ascribe to this quote unquote recovery. And again, as I mentioned, our good friends at the WSTS raised their forecast for this year, not arguing whether it's right or wrong. But what I would tell you is it's quite simply not a recovery that is raising all ships right now. The market is being driven by really two product sets. One, high bandwidth memory benefiting the memory suppliers, and two, it's clearly a NVIDIA driven recovery. And I would also subscribe to this, that those two markets are actually leading to predominantly an ASP/mix trade up, driving the sales growth relative to actual units. So again, as we think about this going forward, and as we look at this for the more broadline markets that my team focuses on at Edgewater, we just wanted to level set with everybody that we think there's a lot more work to be done. With saying that, really wanted to walk through that question. And this, I would say, is almost the number one question that we've gotten throughout the second half of the year. How much inventory was ultimately built in the supply chain? And then more importantly, what does that mean going forward? So a lot going on this chart, so I'll walk through it relatively quickly. The light blue line here is the WSTS reported demand and demand forecast for 24 and 25. And again, with the caveat, the updated forecast came out today, so they would actually be higher. The second one is what we would term real demand. We are firmly in the case that the semiconductor industry over time grows at a 6 to 8% CAGR, which for that record is wildly healthy and robust growth. But we look at this and say, any growth above that is probably inventory being built in the supply chain. Any growth below it is us taking inventory out. And then ultimately in the gray shaded or barred one, we've stripped out the NVIDIA AI growth numbers, because again, as I mentioned in the previous section, what NVIDIA is doing in the AI world is nothing short of remarkable. But I also want to highlight right now that what NVIDIA is doing is entirely a rising tide raises the NVIDIA ship, not a rising tide raises everybody else. So as we go through this, as you can see in 2019, we actually burned a touch of inventory relative to that 7%, or I'm sorry, 2019 is the base. 2020 burned a little bit of inventory, nothing, material before the shortages took hold, and you can see the deltas there. So in 2021, we're estimating we built somewhere around, call it 50-ish billion. It's actually 54 and change in 2021 of inventory built in the supply chain. That number peaked on an annual basis, nearly 80 billion in 2022. And then even as we entered correction territory, we were still building inventory or out shipping that real number. And again, this is stripping out the NVIDIA growth because the rising tide raises the NVIDIA ship. And then ultimately in 2024, burning inventory, and we'll see what 2025 holds. So to look at this in an aggregate basis for everybody here, this is you looking at the cumulative impact. So again, 2019 base, 2020 we were under, so drew down. It ended up being about 5 billion. So again, not material. Almost 55 billion in 2021. When you look at the growth in 2022, we were close to 129 billion before peaking near 138 billion. Kudos to the supply chain, and I know everybody on here who's in the industry knows how painful 2024 was. We did, it appears, burn about $30 billion of inventory via under shipping, and then it looks like we're ultimately set up to shape up to burn inventory next year. Couple of very, very important caveats when you think of this chart and you look to use this chart potentially beyond. While I feel confident in the overall analysis, I think it is hard to make a leap and say that there was close to 138 billion of inventory. I'll talk more about this when I get to the PC end market demand slide, because I think that's a great way to talk about pull forward in demand. But what I do feel confident is this number is one of two things: either inventory in the supply chain, one, or two, it is demand pulled forward from future growth into the current year. It would be impossible, nor do I know the answer of exactly what percent you could ascribe to either of those buckets. But again, do feel in aggregate that when we exit this year, there's roughly, call it $107 billion of either demand pull forward and or inventory in the supply chain. And that roughly amounts to one inventory turn. So again, I think it's more important than the dollars to say there's probably about a turn of inventory left for the supply chain to work through. And we're ultimately using that to kind of level set our forecasts at the end, where we do think we're probably still in an inventory drawdown through the first half of next year, if not into the third quarter, before we start seeing any reasonable return to growth, or at least shipment to a consumption level. How did we get there? And I think history repeats itself is really the best way to look at it. In 2020, 2021, 2019, 2020, and 2021, we had 3 straight years of double-digit capital expenditure growth in the industry. And for all of those on the call, if you went back into history, the last time we had 3 straight years of double-digit CapEx growth, it was in 99, 2000, and 2001. And we all know how ultimately that ended. There are clearly differences between 2024 and 2001 in the sense of technology is much more pervasive. It's used in a whole bunch of different markets. It's not just a one market, being the .com/Y2K build out. It's not one market driving the industries. However, when we were all living in the shortage, and there was a very, very pervasive narrative that we will never ever be in balance again, we would ascribe to the thought that that's unequivocally false. There is more than enough capacity out there. We have invested plenty across all product categories for future growth, that when we look out to next year, really the only place that we see any pockets of any significant tightness is in the advanced process nodes, which again, I would ascribe to the NVIDIA impact at TSM specifically. When you get into some of the more legacy process technologies impacting the analog markets and the likes, we think there is ample supply to meet future demand. That does not mean cyclicality has left the marketplace. The market is very cyclical. When you look in general where we sit today, most semi companies are running somewhere probably between 60 and maybe 75% utilized. Most of your passive suppliers are closer to 50%. So again, we could see near-term supply shocks. We could see near-term shortages. However, what I would tell you is I don't think in my career I will live through another shortage like we went through in 2020, 2021, and 2022, because we have invested in more than enough capacity for the industry. As we move from the supply side and we move into the demand side, again, when we go back to that, how much inventory, keep in mind from a total sales market that what I describe here in the PC market, because I do think the PC market is the best tangible market to point to a demand pull forward environment. So if we look at the overall market, our view is the PC market TAM is a 275 million unit market, plus or minus a couple of million each year. As we look to what happened during COVID, it went from 275 to 300 to 330 at its peak before falling to 295 million in its first correction year. So in aggregate over those years, we pulled forward about 100 million units in demand from future years. So what does that mean? I am not saying there are 100 million PCs sitting in somebody's basement. What I'm saying, and I'm sure this resonates with everybody here, if you had kids at home, I know we did with our house, our 4-year-old during COVID got a Chromebook to do Montessori school. That was a purchase that was slated for 6th, 7th, 8th, whatever grade that ultimately got pulled forward into that period. I think we saw that across the consumer landscape. We also saw that across the business landscape where companies sent employees home, replaced desktops with notebooks and the like. So again, as we think, that's looking backwards. Going forward, what does it mean for the PC marketplace? So as I started with, we still think the PC market is a 275 million unit market, but we think we have to quote unquote digest that pull forward demand. So in 23, roughly 254 million. As you can see in 2024, we're calling it 255. And then again, about 256 million in 2025. And the early looks for 2026 again are another incremental 1 to 2 million units. So again, until we digest that 275 million, will remain, we think, below that trend line, and then ultimately get back to that 275 million unit market, and then largely be, the growth or declines will be tied to operating system changes, general CapEx / IT budgets, etc. So again, I think in aggregate, we don't think there was a fundamental change in demand. We're working through what was the pull forward demand, and we still think it will be a slow climb back to that 275 million unit number over time. As we stay in compute and we move over to the server marketplace, not nearly the correction, but we did see obviously in 2023 a correction that was driven admittedly both by the data center space as well as the sluggish enterprise on-prem environment. What I could tell you in 2023, and this goes back to that NVIDIA halo effect. In 2023, we saw AI units effectively quadruple. They went from about 50,000 units in 2022 to north of like 250 to 300,000 units in 2023, and the same type of growth in 24 and 25 from an AI standpoint. However, what we are clearly seeing with AI is investment dollars are finite. They are not infinite. So what customers are looking at, or what your hyperscalers and the likes are looking at, is how do we allocate our capital expenditures across the data center, potential on-prem, or AI spend. We, despite all of the impressive growth that we've seen in AI, we don't look at it as an and transaction. We look at it as an or transaction, and we think that continues for some time. So the growth again is very, very impressive. However, I would note it is such a small segment of the market from an overall unit standpoint. It's really not enough to save the overall server unit marketplace. A reasonable question that we get almost every call as it relates to AI: what inning are we in from a baseball analogy standpoint? And I think we would say as you look at the AI build out, we're building a new industry from scratch. We're probably in the 7th inning or a touch past. at some point in time, and it's not a 2025 event, at some point in time, the industry will have to move towards a monetization case. And in that environment, we'll look at softwares, applications, whatever you want to call it. But again, we're going to have to move towards creating real, tangible, either programs, applications, etc., that drive sales growth or drive profitability to justify the spend. Right now, again, where we sit immediate term, we're building the infrastructure, and we would expect us to be moving into that either in late 25, more likely 2026. As we move out of compute and we move into the smartphone marketplace, honestly, not a ton to talk about here from a smartphone market environment. When we look at 2024, we're expecting, call it a 1.18 to 1.2 billion marketplace. And I would say the number is relatively similar, 1.2, 1.3 billion total units in 25. What I would say longer term is we think the smartphone has ultimately reached a saturation or maturity standpoint. So again, we think this overall TAM is somewhere in that, call it 1.2 to 1.25. As you can see from a 5G standpoint, the penetration is getting increasingly high. So again, we don't see smartphones as a key driver of growth for the industry. By all means, that doesn't mean, certain suppliers that are highly levered can get onto a right product standpoint, et cetera. Those exceptions definitely are there. But again, from the top-down standpoint, we think we've entered into a maturation phase of the smartphone market, and we're looking at more stable to slight growth going forward. When we move out of, more consumer-centric products, and I guess the automobile would be consumer-centric as well, but when we look at the automotive market globally, it is a market of haves and have-nots. So, when we look at 2024, what I would tell you from a global production standpoint is, we were roughly in the, call it 87.5 million range, roughly flattish year over year. Most of your other market prognosticators were significantly higher than we were, and we've seen kind of the reality shift back to our number consistently throughout the year. To that point of haves and have-nots, we've seen some pretty diverging trends underneath the cover of these top-down numbers. One, if we look at Asia, in particular China, the growth in EV there, especially from the domestic OEMs, still remains relatively robust. What I will say right now, there's roughly, call it 170 to 175 Chinese domestic OEMs. We do think there will be an OEM rationalization. So as a Western supplier, it's hard to pick winners and losers, but the market growth supports playing with everybody right now. So you've got continued strength in the China auto market through the remainder of this year with a robust outlook for next year. When you shift to the West, it's definitely the have-not marketplace. First and foremost, this year, we saw a significant pullback in the EV marketplace with roughly 20 to 30% of all EV programs either canceled and or delayed into next year or beyond. I think when we look at EVs in general, EVs in the West will remain a headwind to mix. I think when we look at the marketplace, we think that the early adopters have already purchased their EV, and we think holistically what's needed to at least reach parity with the internal combustion engine. We're looking for a user experience that frankly rivals what you get with the internal combustion engine. You need battery charge times 300 miles plus. You need the same access to charging stations. And candidly, even with the fast chargers that take upwards of 20 minutes on a full charge, we need that time to be lowered. So again, the user experience can mirror what somebody with an internal combustion engine is. So what I will say, in an environment where 20 to 30% of the units come out, it is good to see that by and large, the slack was offset near term by the internal combustion engine. But again, what we've seen in the news is very much a reality. Here in the US, concerns over interest rates, concerns over demand, and I'll talk on the SAR in the next slide. But again, automotive to us is still a strong growing market that works for the industry, but we don't think it's the continued 10, 15, 20% grower that we saw through the shortage. We think in an overall flat to slightly up production environment without the significant EV kicker, auto's moving more back to that 7, 8, potentially 9% grower over time. As we move from production, we look at SAR, and again, I could have pulled up various stats by all different countries, but in the efforts of time, I just went with the U.S. market. That's one of the largest ones. Really a good news, bad news scenario here. So for 2024, looking backwards, admittedly knowing there's only a few days left, forecast to enter the year were 15.5 to 16 million units, flat to slightly down. The good news there is I think we're going to come probably at the low end, so call it 15.5, maybe a little bit more than that. So again, in line with the target range. That is the good news. The bad news to that, and you could see with the SAR, prior to COVID, we were operating more in a 17, 18, 19 million unit basis. We're 4 million past that peak. So I think, when we look at 2025, our forecast is 15 to 15.5 million. So again, flat to slightly down. Again, when we think about this longer term, the question that we ponder or ask is how does the business perform in an environment where the SAR is between 15 and 16 million versus 18 to 19 million? And we would subscribe that, again, it works in that environment. You have electrification, you have the transition to hybrids, which is still robust. You do have growth in EV, albeit at a much, much slower rate. And when you add all those together in the West, that still gives you a high single-digit growth environment for component vendors in the automotive segment of the marketplace. As we move out of automotive and we move into the industrial, or I think what a number of people would consider kind of more of the mass market here, serviced by distribution. A couple of things that jump out, and very similar to the auto. Could have pulled this data across several countries in the efforts of time, kept it just to the U.S. But as you can see, in general for the U.S., we have been in largely a flattish plus or minus type growth environment from a top-down standpoint from manufacturing. And I think to source or cite another economic statistic, this largely reflects and agrees with global PMIs that have been, call it in the high 40 range or just a touch in the contraction zone. We are in an environment where in a relatively normal GDP, manufacturing goes flat to call it up 2%. When you look at our industry and the electronic components, there are key drivers to outgrow that. Automation, robotics, general electrification, IoT, these are all still very, very healthy, robust, and good markets. Right now, as referencing back to that slide on inventory, right now the industrial markets, in particular distribution, is sorting through inventory. But over time, when inventories move to more balance, again, we look to this to be a 6 to 8% type grower, highlighted by the secular trends that have not changed in our view. Lastly, from an end market standpoint, I'll touch on the defense industry and really, what I would say, and unfortunately, in light of everything that's gone on in the world over the last 3 years, the defense market has come into focus for all the wrong reasons. But if you look at the data over a long enough time, what you can see is we've been in a long-term secular growth environment from total defense manufacturing and shipment standpoint. Likewise, in the book-to-bill over a 20-ish year window, the book-to-bill approach is 1, no surprise there. But what I would tell you is you think about electronics and what it means going forward. It's always volatile. It's always program driven. But in general, militaries across the globe are preparing to fight the war of tomorrow, which is not the same as the wars of today. They involve cybersecurity, they involve hypersonic missiles, unfortunately, or that's the perceived war of the future, I should say. And in that environment, it is requiring an increased digitalization of our armed services. So again, while this business can be lumpy, it can be project driven, we kind of look past it on an overarching 10 to 20 year basis and say, nothing's really changed. This, again, to us, falls well within line of the CAGR, and we look for those types of growths to continue. So to wrap it up, what does it all mean? So for 2024, again, only about a month left, and I know it, in a overarching, slow recovery, we have the number pegged at this year for 1%, next year ex memory at 4%. As I mentioned earlier, our good friends at the WSTS updated the numbers. The 1% number for us this year is really too low. We were undershooting the NVIDIA impact. So it is probably higher. But again, I think when you peel back the numbers, again, what I highlighted in that inventory chart, when you peel back the numbers, if you're a non-AI centric supplier or that's your business, we think that one in kind of low single digit environment is probably more of a reflection of the reality without the AI halo effect. As we move out of semis and we look at the interconnect marketplace, this year, have it close to 5%, next year 5.5%, almost 6%. And I would tell you, we still think that's the trend in 2026 and beyond. While you don't have the same kicker that you do with NVIDIA, interconnects is one subsegment of the market where we have seen a tangible impact in the overall growth and markets being created. However, what I will tell you again is you look at that, finite versus infinite CapEx. While we have seen growth in the IT datacom center of the interconnect marketplace, what I would tell you is the growth that we've seen from AI has pulled the whole market up. It's also offset a relatively benign data center market and then ultimately a depressed enterprise on-prem. And lastly, I'll cover the passive industry. Again, low single digit type growth this year, moving into that mid single digit for next year. I think in aggregate, when you look at these markets combined, the number one question that I got when we were at Electronica was, if you look to your forecast, do you see more risk to the upside or downside? And what I would honestly say is to the upside, and the reason being is supply driven. Again, as we look at the market, the demand drivers still remain largely in line with the historical trend. We do think we've overshipped the industry. And with that, we have seen, as I referenced, semi suppliers running underutilized, passive suppliers running underutilized, and the like. So a return to shipping to consumption could provide a near-term lift, but again, we don't see long-term shortages anytime in the future. So with that, just to wrap out, a couple of things that we're watching this year and beyond, ChatGPT and others, again, talked about it briefly. Really, what does it mean in terms of monetizing this? Quickly, what do you get, or what does a President Trump 2.0 look like in the U.S.? A lot of talks and discussions around tariffs and what that potentially means. Again, general discussion about taxes, etc. I touched on this again briefly in the effort, in the effort to be cognizant of time. How do we ramp in new geographies? Again, whether it's been nearshoring, whether it's been diversifying out of China, a number of suppliers have untested geographical supply chains right now over the CapEx spends over the last several years. So while we're underutilized today with the bottom forming, what does it ultimately mean when we try to ramp it? And then lastly, just what does competition, pricing, and second sourcing look like going forward? And with that, I know I've covered a lot, so I'll pause there. What questions does anyone have in the audience?
Thank you so much, Denise. Before we even get to the audience, I've got a battery of questions for you personally. I'm not even sure where to start, but I think I'll start from something that's a little bit much more political than just about inventory. And I think I will get to the inventory questions also. The election of Donald Trump as incoming president of the United States has triggered a lot of concerns across the industry. Some of these, very few people want to actually address it. We've written about it, and my personal opinion is that are we making too much of this in terms of the potential impact on the economy globally, and by extension, the electronics industry?
Yeah, so it's a great point, and I think when I look at with the caveat, we focus more on the industry than we do on predicting broad GDP growth, et cetera.
Right.
But of course, we can't have our head buried in the sand with it. I think objectively, when you look at President-elect Trump, there rightfully so, and it surfaced a lot in our conversations, the talks around tariffs in particular, and what does that mean from an inflation standpoint? What does it mean from just a geopolitical tension standpoint? And I think when I step back and look at it, if you go back to Trump's first term, when the sanctions and the entity lists and everything else were put in place, while maybe the intentions were right, we could debate the strategic implementation of it or tactical implementation. But any way you want to say, in Trump's first term, the Biden administration has taken whatever Trump has done and accelerated it. So if you look at the tariff,
Exactly.
if you look at the tariff question, it was 25%, it's going to 50% in, basically the first of the year. That is not a Trump impact. So, I think you might be right that, I think there's some real near term, what do tariffs have an impact overall on inflation? I don't think suppliers are going to eat all of it. I think it's going to be shared across the consumer. It's going to be shared across suppliers, distributors, et cetera. So, that's one thing I think we have to iron out. But again, I don't think that's unique to just a President Trump term in office. So, and for that, I think there will be clearly a cut in taxes. There will be clearly a cut in regulations. And those are, good for the quote unquote animalistic spirits of the US that unleashes innovation and all the other buzzwords. So, I think I would come to probably your camp that, the election leading into it was by and large a distraction, candidly. I think there are probably certain subsegments, whether it's, the industrial oil and gas, that will outperform other markets like EV or green energy or things like that. But again, you can't, to me, you can't regulate and or nominate your way to growth in those markets like EV, right? You've seen it in Germany. There's a new snap election, I think in January or February. The subsidies and things like that in those markets are now uncertain. So again, it's not just the US. I think in general, the consumer has pushed back and has said in particular for Western EV suppliers, by and large, your product isn't comparable. And we're unwilling to fight the mandate, to drive that. So, again, I think I'd agree. I could talk a lot out of both sides of my mouth, politically and what it means, when standing on a soapbox. But I think I'd agree. It's clearly uncertain. I think when you look at the biggest risks, China in the West, we need to get some adults in the room to figure this out. I don't think there is a clear or realistic way to decouple the West from China. And, like it or not, China is not doing anything different per se than when it was the 12th or 15th largest economy in the world. The difference now is they're the second largest and trying to grow.
Right. If we go back just to this whole question of the inventory overload, I always thought that you can't go from growing 10, let's say 5 to 8%, and then all of a sudden, or even let's take an example of lead times. Lead time 6 weeks, 8 weeks, and then you go from 8 weeks to 12 weeks to 15 to 20 weeks to 52 weeks, and we don't see anything wrong in that. I mean, how would you expand demand so much that lead times begins to jump that high and red flags are not flying all over the place?
It, it's a funny question and point. So every t- there, I've given a presentation in the past, and I think it's very, very important to discern between the cyclicality and then the structural growth when you look at
Right,
electronics and electronic components. So structurally, as I mentioned in the presentation, 6 to 8% without a doubt. However, I could find any 3-year window that shows an aggregate 30% correction, and typically you see one of those every single decade, right?
right,
Um, so I think that comes back, to what you mentioned with the lead times and everything else. Every time we get tight, every company, every time we get tight, this time is always different, right? We've put every system, et
that's
cetera,
true.
in place. And I could always play it forward, whether it's next year or 2026 when we do see, lead times pop, let's say in something like an MLCC. In this case, it'll be, well, you could envision the narrative will be, well, we've got these new AI systems in place. They fettered out all double bookings. But at the end of the day, it's exactly what you mentioned. If lead times are 8 weeks and you try to turn your inventory, once, you're going to give 8 weeks worth of backlog. If lead times go to 52 weeks, you're going to get 52 weeks of backlog. And when they go back to 26, you cut it in half. So I
Right,
don't, I don't think in that case the cyclicality is ever going to leave our business. It's been cyclical forever. It's when you think objectively, any Western OEM for an automotive, like you could shut down production for a half a penny part on a 60 or $80,000 vehicle. You're
right.
just not going to do it. You're going to double and triple order because the cost of not doing it far outweighs it. On the flip side, with where we are, the cost of holding the inventory is also perceived, because right, we typically end up in these inventory corrections when demand slows, the broader
Right.
economy is slowing, right? So you know, I, yeah, there's no way kind of around it. I think in terms of the cyclicality, but again, it doesn't, and when I talked through the slides today, tried to balance, what is kind of the long-term view of the market, which is that structural growth, in particular for auto and industrial and markets like that, but then balance the harsh reality that the market's cyclical and we'll continue to work through that.
Let's take a deeper look at the NVIDIA effect, like you rightly identified it. You have a company that I don't have the numbers. It went from $9 billion or so, maybe 4 or 5 years ago, and now it's shooting at over $100 billion in terms of growth. So, the question is this: you've identified the Nvidia effect on the semiconductor market, to be precise. It kind of gave us this impression that we have a recovery, whereas if you look at the results of so many other companies, there isn't a recovery, right? However, what I would like you to explore now is, what are the challenges? This is a question from one of our listeners who want to know, what are the potential challenges that could emerge from this Nvidia effect? Do we see supply chain challenges, inventory management challenges? What kind of challenges do you expect?
Yeah, no, that's a great question, and I'll answer it a couple of different ways. So, one challenge is, and we get this regularly just in our business, is how do I frankly make sense of all this data, right?
Right,
I'm I'm and I'll make up a title. I'm the vice president of sales in the America, and I've been challenged for my annual budgeting to do a bottoms up forecast for next year that goes to the board, and I roll it up to 2%. And then I bring it to the management team, and they look at those high level numbers, and the WSTS has the Americas at 25%, and there's a complete disconnect. So, one I think is making sense of the data and what that means for your business, and engaging with people that can help you make sense of the data, and also create that quote unquote story inside of the company of what does this mean more specifically for our business. So, that's one on kind of a data and analytics one. Two, I think when you look at, and you reference some of the numbers, I mean, nothing short of remarkable. My memory is going to slide exactly what quarter, but, NVIDIA's data center group sales bottomed around 5 billion in a quarter. In the most recent quarter they reported was like 32 billion and change, close to 2.5-3 years later. So the growth's been remarkable of size. So, near term, I think there's real and rightfully so supply chain concerns as it's related to 7 nanometer and below front end wafer capacity. I think you're seeing that with TSM, and that's an environment where pricing is robust, and there are capacity constraints. That doesn't by and large impact the broader market. I think you could say the same with the back end, with some of the assembly and test, more advanced assembly and test, and package types and things like that. Tightness, bottlenecks, those kind of continue as we grow in, to this kind of basically seeding a market that didn't exist 3 years ago, that's now north of 100 billion plus spent in aggregate, right? The second one, when you think about, or at least when we think about, where this goes, and I touched on it quickly on that NVIDIA impact, and tried to use the baseball analogy. At some point, the growth is going to slow and the market will mature. I don't think it's next year. So don't, anybody, please don't construe it that way. But when it does, what does that mean to the supply chains of people who are levered and or trying to capitalize on that one subsegment? It's a reasonable question, one. And then, I think two, when you look to the broader market, we touched, again, this goes back a little bit to that overarching data question. Just to give a kind of like for like, if you were to take a standard kind of Xeon based server rack, Intel's processor would be $8,000. NVIDIA on a like for like would be 24, going to 45 next year. So you're getting 300% growth on one unit. So we are seeing a disproportionate, and I'm sure there are others who have been in the business longer than I that can recall this level of a quote unquote recovery that has been purely ASP driven versus unit. But I can't recall one that's looked like this, one, and two, I ponder, what does that mean overall for utilizations when the growth is not necessarily unit driven, it's purely ASP/mix. So I think I touched on those, but yeah, a bunch of different areas, and it's a great question.
Thank you so much, Denise. It's really been an eye-opening discussion. I think there's going to be a lot more to be said about what's going to happen with this industry. I'll personally be back to you with one single question, which I don't want to answer now for risen over time, which is, what is your advice to this industry? What specifically should companies be doing? And not just about the AI effect, but also about this inventory that's somewhat hidden in the industry.
Yeah, no, I'll wrap up with that one in a last one. I think there's, if you look at the inventory one, and I gave this presentation early in the correction, actually at the top of the market. And the question back then everyone asked was, if you're right, is it short and shallow or fast steep? And, my answer at that conference was, you're all here, get in the room, allow people to cancel orders, scrap orders. And unfortunately, the supply chain went non-cancelable, continue to enforce it. So to some extent, we've kind of made our own bed that we're sleeping in right now. Where we sit, come up with a way to write down the inventory, clear the deck, because it is, when we look at the growth, and there's nothing tangible from a data set with this, new projects are clearly being delayed based on too much inventory.
Right.
And the faster we can get everyone in a room, whether it's distribution, EMS, the individual suppliers, and work through a way to, by and large, I think the answer is probably write off that inventory, and get it back to a more normalized level. That's going to keep growth kind of subdued. So I think, that's one from a tactical one. The other one, again, I think it goes to the core of what we do. Data sets in general with the halo are real, but becoming less reliable until that market kind of corrects and or the other ones grow in. So aligning yourself with providers that can help you make sense of it and draw real conclusions to what it means for your business, and then position your business appropriately. We've clearly seen an influx of engagement in that sense on our end. So I think, working through making sense of what to do in a data when it really is a market growth that's ASP, that's, ASP, there's a little bit of inventory, but it's really just a one company recovery. I think that's the other one too, to really ground all your stakeholders in the reality of what the market looks like.
Excellent. Thank you so much. Today's read with Edgewater Research helping us to make sense of the current inventory situation in the electronics industry and the NVIDIA effect. It's really been a pleasure, Denise. We hope to have you back. For the rest of our attendees, your next session starts shortly. You can join by visiting the lobby and clicking the join button, or you can navigate to the main stage session start. We look forward to seeing you there. Denise, it's really been a pleasure. I want to wish you happy holidays.
Thank you, and everyone, thank you for giving me the time. And my contact info is also in there, so please feel free to reach out.